here's the thing. These rating agencies aren't taking two really, really important things into consideration. Number one, real median household income. And number two, the out of control deficit in government debt right now. Rating companies are ridiculous and designed to continue to get us to spend our money. They are reactive. They will only change their rating when it's too late. When we talk about renting versus owning, you got to make $50,000 more just to qualify to own a house.
People drove to Florida to see, okay, what was going on in the housing market. People were done at that point also. Are we at that stage where it's like, okay, this is a bubble, we got to get out? Is this where we're at? Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffmann. I'm the @JR Mining Guy over on X, and of course, your host of this channel. And I'm looking forward to welcoming a first-time guest to this program. He's the host of the Real Estate Mindset. It's Travis Spencer. Really looking forward to having a really holistic discussion with him, because we'll start off discussing the economy and the bond market, because that really sets the stage to what is going on and what will be going on in the housing market. How can you buy a house right now? How should you be looking at things? And how's the real estate market in general doing in the US right now? Really, really tricky market, to be honest. And it's not looking great. Just not trying to give too much away from our conversation, but it's not looking great. And Travis got some great advice for you. So stay tuned for that. But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously. And it's a free way to support the channel. Tremendously appreciate that. Now, Travis, thank you so much for joining me on the program. Thank you so much.
Kai, it is an absolute pleasure to be here. I really appreciate you letting me speak to your viewers and letting me on this platform. And it is, for the housing market, my friend, it is not looking good. Any mathematical formula that you're looking at from both price and payment standpoint, I mean, things are absolutely out of control in the housing market. It has never been more toxic than it is right now.
Absolutely. And we can see that daily, just opening the newspaper, you know, it sounds like an old school saying, maybe or open up your computer, turn on your phone. I'm not sure what people say these days anymore, because I actually subscribe to a financial newspaper again, just to pretend that I can stay on top of things, quite honestly. It's insane. But Travis, let's set the stage first. Let's figure out who you are and where you're coming from. What is the real estate mindset?
Yeah, so I'm the host and founder of a YouTube channel called Real Estate Mindset. Real Estate Mindset is a community that we're working on, you know, basically one of the first of its kind communities. There is no community like the Real Estate Mindset community. What we've done is created a platform, whether you own a home or renting. We've created a platform to help educate current homeowners, fight property tax, fight expenses, fight things like that. And also renters understand how to purchase a house. Because one thing that I've noticed with this whole real estate culture, YouTube, all of these investors is their advice is absolute garbage. Most of the advice that people are getting online and about real estate is cheerleading. That's it. That's all it is. So what we do here is we offer free courses, free downloads to teach people the math on how to find a great deal in real estate. And here's a clue, you know, spoiler alert, it's very hard to find a deal right now. So I don't know, if you're listening to people that are overly optimistic and cheerleading, you probably want to stop listening to them and start figuring out exactly what's going on with real estate. And here's the thing with real estate, and I'll shut up. Real estate's very confusing because you have a couple things. It's so bifurcated. So there's so many different things going on in real estate, and there's different levels of investor, different goals. But essentially, you can break real estate into two things: existing homes and new homes. And then from there, you can go home buyers pre-quantitative tightening and post-quantitative tightening. So it is difficult to understand, but all you have to do to really determine whether or not a home is overvalued is you have to do hyper local subdivision analysis, where you go into the actual subdivision and you use the math, figure out what homes are selling for, and from there you can determine how under market value a listing is or how over market value is. And no one's teaching those fundamentals, and that's what we're doing here at Real Estate Mindset, and I absolutely love it, and I appreciate that plug.
No, absolutely. No, our viewers, of course, try to understand what that real estate mindset is and how we can approach the conversation here. Because we need to talk about the economy first and some of the economic trends you're following in regard to what you're discussing on your channel, of course. What are some of the main topics you're focused on? I touched on bond market, of course, and we got to talk about the Fed. So what are you seeing right now? What kind of trends have you been following here the last, 3-4 months?
Yeah. Well, I mean, for the last 3 years, I've been following, when all said and done, I've been following the fraud that has been happening with mom and pop, which is the economic engine of the United States of America. 70% of GDP is from consumer spending. And so some of the topics that I've been covering is obviously the housing market. I've been digging into that for years. Again, it's extremely bifurcated. But in addition to that, some of the things we're doing within the Empowerment Center, free courses at Real Estate Mindset, is we're also monitoring the property tax crisis. We've been able to show our viewers and prove mathematically and with law that the property tax crisis that's going on right here in Texas is straight fraud. So they're equity stripping homeowners right now by overassessing our properties. So in other words, and I know I'm kind of going off on a tangent. In other words, what they're doing is they're taking a budget, say the school district, okay, a taxing entity, a school district has a budget of X amount of money, they need bonds. And what they do is they back that budget into the values of our houses using fraudulent software that is supposed to use something called USPAP to properly calculate taxes. So I've been really trying to end property taxes. Another thing we've been following on, which is really scary, is how levered up and exposed pensions and 401ks are. And mom and pop are about to get absolutely annihilated with pensions and 401ks. So we've been following that. We've been following what the Federal Reserve is doing, quantitative tightening, federal funds rate, the stock market. We've been trying to keep our hands to the pulse in every aspect of the economy because we don't want people to get bamboozled. Now, I got bamboozled in 2009. I lost my house. I had a foreclosure, a repo, a tax lien, and a bankruptcy in 2009. It took me 9 years to crawl myself out of the gutter to get to where I'm at today. And so again, going back into what Real Estate Mindset is, I don't want that to happen to people. It's really easy to get confused when it comes to the housing market. It's really buy into the narrative that it's just okay, that home value goes up 8 years and in 10 years, right? It goes in cycles. But what people fail to realize is, and this is probably the biggest thing, right, that I've been following, real median household income. Nobody wants to talk about it. No one. And they don't want to talk about the debt. And so the last thing, we right now, I don't even want to say we're in an everything bubble. All right. My co-host, Mitch Vexler, this is a great man, he's very, very smart man. He's coined a new term, new bubble. We're in a fraud and debt bubble that is unraveling right now. Fraud and debt, everything is levered up. Mortgage-backed securities are levered up. The Federal Reserve, owns our houses in the form of Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are the long arm of the Federal Reserve. And so I can go on and on about these things, but those are some of the things I've been paying attention to.
No, absolutely. Lots going on, and it is really difficult to keep things up. Just the ones you mentioned, like levered pensions, 401k, Fed funds rate, mortgage rates, bond market, stock market, and everybody's paying a little different, or it's weighing it differently. So yes, lots going on. Maybe let's focus on the fraud part first. Really curious, because the debt part I think is easy to understand. People are over levered, and there's so much debt. The U.S. debt is a national topic now. It's a national security issue as well. Let's talk about the fraud. You talked about the property tax situation as one thing, of course. But where else do you see fraud here?
I mean, where else? I mean, where do we see fundamentals? Anywhere we don't see fundamentals, the inflation is the fraud. Anything that the inflation touches is the fraud. So I see fraud in everything, in financial advisors, Wall Street. It's paper chasing paper. They're lying to us. They're hiding the data through things like methodology. We can't even access raw data. And so you have it in the media, the talking heads, you have it on YouTube. Anyone with a financial bias that is pushing a narrative to sell something or to get a commission is fraud. And so I would say probably the most overwhelming fraud would be, we won't talk about Fannie Mae and we won't talk about qualified mortgages yet, because they did change qualified mortgages. They removed debt to income ratio out of qualified mortgage, which was through the Dodd-Frank Wall Street Reform Act. But brother, I would say the biggest fraud of all is the fact that mom and pop are still making the same amount of money that we were making in 2018. And so the biggest fraud is the inflation. They're robbing us. Anytime the Federal Reserve, central banks print money, all that happens is a wealth transfer. They make the elite richer, and they bring millions of Americans into poverty for decades. And so I say the biggest, this snake's head is the Federal Reserve. The Federal Reserve right now needs to be shut down. They have $6.7 trillion in assets. Those assets need to be unwound back to mom and pop, and they have 23,000 employees. Brother, the Federal Reserve has 23,000 employees. What the hell is the Federal Reserve doing right now? They don't know what they're doing right now. They're completely useless. all that they're doing is backstopping the banks. They have swindled the U.S. government. They have swindled the taxpayers, and they are absolutely out of control. And it's hard to know what's fraud. I mean, what's not fraud, because again, there's so much inflation. There's so many data endpoints that's fraud. And even if it's an official that doesn't understand that they're involved in fraud, then at best they're useful idiots. So the really hard part for America right now is finding out the truth. And the truth is hard to find out because, again, data manipulation, methodology, and the fact that there's an overwhelming amount of financial advisors and talking media heads that are paid to say something. And so it's a true crisis that's going on right now in America. And all I want, brother, I want to live in a home that I own, that I can afford, and I want to like my home. I'm not willing to overpay for a house right now, even if I love it. And it's very sad what's happening. And I would say another area of fraud, and this is huge, other than the property taxes, it's all of the fat in the middle, right? It's all of the people collecting fees, the non-banks. I mean, think of all the non-banks, think of all of the fat in the middle. And the system's broken. The system's broken right now. And all that they're doing so far is just, they continue to kick the can down the road at the expense of, well, now the world, but of the American consumer. Mom and pop is dying out there, man.
Yeah, no, absolutely. I travel to the U.S. a lot, and you just see it left and right, and they're not doing too great. And I want to stay on the Fed for a minute before we come back to the American dream of owning a home here. But stopping the Fed or ending the Fed is a recurring theme I keep hearing. I had G. Edward Griffin on the program the other day as well. Really smart man. Really enjoyed my conversation with him. You said something interesting, like redistribute the capital to mom and pop, like dissolve the Fed and give the money back to the people. Explain that theory a little bit to us, could you?
Well, they have. If you go to Fred Economic Data right now, you can see that the assets held by the Federal. So we're all suffering, right? The American people, most mom and pops, middle class, lower class, everyone is suffering. But the Federal Reserve is freaking thriving right now. And if you go and you look at their assets, counting their mortgage-backed securities, I think mortgage, and obviously they're unwinding, right? They're doing quantitative tightening, but right now they have 6.7 trillion. I say figure out how to unwind the 6.7 trillion and maybe pay off the actual debt. Nobody right now is talking about the elephant in the room, right? Doge right now, it's good that they're conquering fraud and that fat in the middle and all of these corrupt politicians, but nobody is talking about what's happening under the covers or under the hood, which is the massive, overwhelming deficit and debt. We have 37 trillion in debt, and it's a mathematical impossibility that cannot be paid back. And so instead of them working on paying it back, they just roll it up and out, and they tax my children's unborn children. And so as far as that 6.7 trillion and how to unwind that, we could do a lot with that. It's not going to be a permanent thing, but, and this is kind of going off in left field, one of the things that I would like to see, and again, this is a little bit off of left field. We're trying to eliminate property taxes. We're trying to eliminate property taxes and usher in a consumption tax. Perhaps the assets from the Federal Reserve can help offset some of the state's consumption tax to make it a little bit easier to get out of the property tax fraud situation that we're in. So, but overall, any money that is being saved right now, it needs to go back to removing the debt. The deficit. I mean, the $36 trillion right now. No one's talking about that. We see debt to GDP. It's out of control. I mean, we literally are running a deficit right now as if we're in a Great Depression. If you compare the deficit in the GFC, the global financial crisis, to right now, it's more. It's more right now. If you look at the last 4 years, it's just in. What is very scary, Kai, is mom and pop. A lot of mom and pop don't know. They know that there's a problem, but they don't know how to articulate it. And so that's why I appreciate your channel. I appreciate other channels that have stopped grifting, right? There's a lot of grifters and whatever, it is what it is. And they're painting a picture, but I appreciate channels that maybe make a little less money and they educate. Because people right now need to be educated, because for the last, I don't know how many years, 10, 15 years, we've been on this, let's just buy, everything goes up, spending spree, like Airbnbs, continuing to buy rentals, the whole BRRRR phenomenon. I mean, it is ugly. A home is meant for mom and pop to start a family in. At least that's my premise. Not to own 200 units. Why are you owning 200 SFR, single family units? If investors want to own multifamily, do it. Anyways, man, I mean, I can give you so many different sob stories right now. I mean, I'm so in real estate right now. Is you just tell me what direction you want me to go?
Yeah, no, we'll get to real estate in a second. Just sort of setting the stage of where real estate is right now, and we'll get to that. But you touched on a couple of interesting points, and the last maybe one is QT, because we've discussed it here on this channel as well. The Fed slowed down QT down to $5 billion a month, which could have been zero, but zero would have woken up the market and would have said, it's like, well, okay, we're back to QE here. So they left the $5 billion in, down from 25. Tell us a bit the context. Explain the context of QT on what you've been looking at and in regard to the real estate market.
Yeah, QT is BS. They're not doing QT right now. They're doing QE right now, and they're doing it secretively. It's called the reverse repo market. The reverse repo market is a type of quantitative easing. It's a type of bank bailout. Another QE that they're doing, or they just stopped, and this was in March of 2023, is known as the Bank Term Funding Program. So on one hand, they're saying they're doing quantitative tightening by not repurchasing mortgage-backed securities. They let them roll off of their balance sheet. And then they're also dropping interest rates. So dropping interest rates is a form of it's a form, I mean, it's not technically purchasing assets, but it's definitely when you drop rates, you stimulate the economy. And so money printing, stimulating the economy, bank term funding program, reverse repo market. What about what they're doing is quantitative tightening?
No, it makes sense. It's an interesting market. I've been looking at it because it seems like we're on our way back to QE anyway, like officially. Like, as you said, like unofficially we're doing that already, but and I think it's just window dressing, by the way, the $5 billion of QT here. It's because nobody really picked up on that. Like mainstream media, I know you're not the biggest fan of mainstream media here, and I get it because they're not reporting accurately because nobody really jumped on that on the QT discussion that was or the topic of QT. A couple of like smaller questions, but the mainstream media didn't really pick up on it. So, and we're depending on where you sit on the spectrum here, but it seems like we're headed back to QE fast.
Yeah, right? And I'm saying we never stopped. We may have slowed down QE, but we've never stopped QE. Again, we have the reverse repo market, we have the bank term funding program, and I believe right now that they are trying. Unfortunately, I think that they're moving to QE right now. I think they're putting a bailout package together right now because you've seen the distress in the market. Could be derivatives, but the market is highly levered. It's full of fraud. It's full of debt. I mean, it's debt upon debt and paper chasing paper at the expense of mom and pop. No. It's not going to work anymore. They've maxed it out. We can't afford to continue to live this way. It's not sustainable. And so the Federal Reserve is an absolute tyrant to the American people and to the world, and needs to be shut down.
No, I don't disagree necessarily. My only problem is what's after that. What's after end the Fed plus one? That's where I've been a struggle with, and the chaos that might evolve, chaos like financial turmoil and things like that. So that's where I struggle. It's more of it's like looking up at the stars and trying to figure out where the universe ends, right?
Oh my God, I've done that. It's so fascinating. I love doing that.
But that's where my mind just goes like, okay,
yeah,
blank.
Well, right? I have an idea. How about this? How about if they are highly levered and they make risky investments, that you let them fail like any other business? How about we let them do that?
That sounds too pragmatic. Quite. I would actually appreciate that approach because talking about mindsets, the American consumer or global consumer to a degree has been conditioned that they will get bailed out. Right?
Yes.
And not just the consumer, but also the corporations. So that is a mindset that needs to get changed. So we need to let institutions and individuals to a degree fail. And we talked before hitting the record button, talking about finfluencers owning, and you touched on it slightly, like 200 rental units or so to make money. We need to have those fail.
I mean, it's not. Right? It's mom and pop is failing. 700,000 people in the streets, homelessness. They're hiding foreclosure data. Black Knight says 3 million people behind. HUD says 4.5. The Pulse survey says 6 million. I mean, brother, mom and pop is suffering. Mom and pop is already failing. Why? Every time we bail out these institutions, like I said, all it does is it puts millions of Americans into the crosshairs of poverty, for potentially decades. It needs to stop. The purpose of the Federal Reserve was to stop bank runs back during the Great Depression. That's over. That's done. That's no longer the case now. Now the Federal Reserve is a backstop so that they can continue high risk investing at the cost and expense of mom and pop and the Americans and now the world. And so it's a fraud bubble. It's a debt bubble, and it is bursting because it is not sustainable because they never increased the real median household income, which is the only thing that matters if they want to sustain the prices right now. But the real median income never went up. Just the cost of living exploded.
Yeah. Now, wage growth is 5%. Just maybe for me to understand, like wage growth apparently was around 5%. How does that fit into the median income here? Like, how does that get calculated then?
So I'm talking about real median household income, right? So real median household income is adjusted for inflation. And if you go back, I have the chart. You want to pull it up real quick?
Yeah, for sure.
All right, here. Let me go right here. I'm gonna show you. Now I have a whole bunch of stuff here. Let me pull up. Where did I put real median household income? Right here. Okay, so here's real median household income right here. Okay, so real means adjusted for inflation. All right, and this is only to 2023. They're probably cooking the books, like they're really good at that. But let me point your attention to 2019. Real median household income in 2019 was $81,210. You fast forward to 2023, it's lower. It's 80,610. So that's what I'm saying. The Federal Reserve did this, and a little bit of apathy, which means people need to wake up and hold their politicians accountable. So it's a little bit of both, but this is the fraud. And let me show you something else. If we go back to 1999, okay, so that's what, 26 years ago? 26 years ago, my friend, the real median household income was 70,210, which means we are only making $10,000 more than we were 25 years ago, but all other asset prices and payments and everything is absolutely skyrocketed. What you see here is you see the fraud. That's what that demonstrates right there.
No, absolutely. Appreciate you showing graphics to that regard to drive the point home. Fantastic content there. One last topic. I really want to get to the housing market, but we need to talk about the bond market just the last 48 hours. And what that really means. What is the impact here? Because you touched on the Fed, and I was wondering what Jerome Powell is looking at right now. He's like, crap, the bond market is going, the yields are dropping, bond market is crashing. What is happening here? We have also seen bond auctions. Actually, a 10-year, I wrote the number down. There was a $39 billion auction yesterday for the 10-year, which apparently saw strong demand. So the question is, like, Travis, what's the impact of the bond market on everything here? Because Simon Hunt said on our channel it's the root of all evil, and it can bring the house or the dominoes, or start the flick of the dominoes here.
Well, the Fed doesn't have control over residential mortgage rates. So the Fed has control over the federal funds rate. Mortgage rates are, they track the 10-year treasury yield, right? So the longer end of the yield, the 10-year. So if you track the 10-year, you'll see what's going on with residential mortgage rates. And over the last 3 days, mortgage rates have skyrocketed, and the 10-year is absolutely skyrocketed. It was so crazy because I did a live video on Friday, and the 10-year was under 4%. Okay. What is it right now? It's like it's Wednesday or Thursday right now. I mean, man, I'm so in the data. I don't even know what date it is. And it's at 4.4% right now in a few days. That's insane. And the impact that has on the housing market is if you're on the sideline and you're waiting for affordability, the 10-year going up like that doesn't help you. It doesn't help your case because it's going to send mortgage rates to the moon again. And we were just on Friday when the 10-year got under 4%. We were finally starting to see residential mortgage rates that are FHA, so not conventional FHA, under 6%. So it was like a tease, right? Like, okay, guys, we're under 6% now, right? And then boom, it goes back up. And and why? There's so many people that own the treasuries, and they use those treasuries for collateral, and they lever up the treasuries. It's hard to know why that's happening or where it's coming from. At first, I was like, maybe it's China, but I was like, nah. I was talking to Mitch. China doesn't make sense because they use those treasuries as collateral. Maybe Japan. It's hard to say, but one thing we know and that's another area of quantitative easing, by the way, the Treasury and the Fed buying these notes and treasuries. But the thing is, man, I mean, it makes things more unaffordable, the 10-year going up like that. And it's just, I don't think that, maybe it will be the catalyst to collapse everything, but I think the root of the evil, again, is the Federal Reserve and the hidden inflation tax, which is a fraud to America. And really, the entire world because it's a world currency. So you're really devaluing the dollar for everyone, and you're hurting everyone by printing.
Oh, absolutely. Like money printing has never solved anything. I think even in history, like I'm German, money printing has never solved anything, especially for us over here. So
Right, yeah.
we can write songs and books, and I think we have about that topic. So
You have you wrote a song about it?
no, personally, I'm sure there's songs out
fantastic.
there, right? Like not my area of expertise. But Travis, a bit of a controversial question, but is the American dream dead? And the American dream is you got to own your own home. And
No,
owning
man.
a home.
The American dream is not dead. It's just robbed and manipulated and beat up and chewed up and spit out. I mean, the American dream of home ownership needs to be redefined, and we need to redefine that by using math, right? We need people to understand what it's like to own a home. What expenses can you expect? What adjustable costs are there? If you get a mortgage, your mortgage, and if you get a fixed rate, your mortgage payments are still going to fluctuate. Why? Property taxes and homeowners insurance. So the dream of home ownership, that's the foundation of so many Americans' belief in striving and achieving and being disciplined. I want people to own a home. What I'm saying is right now, it's so toxic and it's so overvalued from both a price and a payment standpoint. It doesn't look like the dream anymore. It's so toxic, manipulated. The greed, the corruption, and fraud has mutilated it. But within all of that, it's still there. You just have to know how to get through all that fraud, greed, and corruption. And you get to the math and you will find it's still hard. Okay. But for example, in my own housing market, and I can show you, I can pull this up right now on my multiple listing service, but I can find homes right now in my market that are priced at 2020 price points. Okay. So I can walk into a house with 20% in wedge or 30% in wedge. The problem is when I do the cash flow portion of that, it doesn't cash flow. It doesn't cash flow because the property taxes have absolutely skyrocketed. Homeowners insurance has absolutely skyrocketed. And just the cost of living overall has absolutely skyrocketed. And I'll say this, for a lot of people, brother, the dream of home ownership is suspended.
Love that term. The American dream is suspended. That might be the title of this video here, Travis. But I've asked Michael Zuber and Melody Wright the same question. So I'm curious: like, is the U.S. is there a structural change that you're seeing in the market? Meaning, are we going from home ownership to rental?
The fundamentals aren't there. So when we talk about renting versus owning. An article just came out, I think it's the 10th, came out this morning saying that if you are renting versus owning, you got to make $50,000 more just to qualify to own a house. When you look at the gap between how much it costs to rent versus own, it's roughly, depending on the data, in a difference of $823. So it costs you $823 more a month to own a house. And what people fail to understand is how an amortization schedule works. And that's a mortgage, right? If you have an amortization schedule, your real true interest rate, if you get, say, 7%, is 140 to 150% because amortization schedules are front loaded with interest.
Yeah, no, it makes sense. I'm just curious because in Germany, this is a renter's market. All right, we're not homeowners per se. Like we rent. In the U.S., it's more of a homeowners market, percentage-wise. I think Germany is the highest actually even in Europe, but renters is 53 or almost 54%. And the U.S. is way lower. I forgot the number, actually. I looked it up the other day. I have to admit, I forgot it. But I'm wondering if that is changing because you can't afford a house right now. You just can't, based on what you've been saying. Like, it doesn't even have to cash flow. Even if you want to buy it for yourself, you just can't. As you said, the real medium income hasn't gone up to be able to afford that.
Yeah, I mean, even people renting right now are struggling, and that's why commercial real estate investments are failing so much. I mean, you got to ask your tenants to pay that much money on a brand new commercial building downtown. That's not going to work. Again, mom and pop, can't do that. But back to your other question, as far as systemic changes, another thing that I've noticed, because I was also a loan officer during the global financial crisis, is how systemic the fraud is, how leveraged up our homes really are. The non-banks really got out of control. It wasn't supposed to happen like this because, again, when we had the global financial crisis, they made the Dodd-Frank Wall Street Reform and Consumer Protection Act that ushered in something called qualified mortgages. But the qualified mortgage criteria failed us. People don't realize that yet. They're like, no, it's not subprime right now. Loans are better. And that's true. I'm going to go on record and say right now, because I was a loan officer, it's harder to get a loan right now than it was during the global financial crisis. But the main reason is, and we'll say it now, income verification. That is a primary difference between right now and back then. It's not debt to income ratio. It's income verification. Back in the past, you could state your income and the underwriter didn't have to prove it. Now you got to prove it like 3 different ways. And so what happened was I think this was during COVID, they removed the debt to income ratio threshold. I believe it used to be 32% maximum debt to income ratio, 32 or 36%. And then they changed that to 43. But the crazy thing, okay, so again, qualified mortgage, maximum debt to income ratio, 36, they changed it to 43. But here's what I want to tell you. As someone that has been a loan officer, the lenders, whether non-bank or direct lenders, or even a broker, which is a non-bank, they never adhered to that rule. They've been using this entire time through FHA, 56.99% debt to income ratio. The way they're able to do this is they submit the file through something called AWS, Automated Underwriting System. And if Automated Underwriting System, they analyze the file, they say, it's okay, debt to income ratio is 56.99, you have an accept. And an accept means that Fannie Mae and Freddie Mac are going to buy that loan. So not only did they change the laws, not only are they not enforcing the laws, they are participating in mortgage fraud in the form of purchasing the mortgages from the lenders that are violating the QM laws to begin with. And who owns Fannie Mae and Freddie Mac? You can argue that the Federal Reserve does, because they have trillions of dollars in mortgage-backed securities. And that's why I say Freddie Mac and Fannie Mae are the long arm of the Federal Reserve, and they too need to be shut down.
It's just my head is spinning. You might be able to see it on camera. I'm not sure if you could see it, but it's literally spinning. It's a lot to digest here, just because it's interesting. Like it's a very deep dive into the topic. Because in the end, like the global financial crisis feels 3.0 feels like it's around the corner, right? And you touched on delinquencies earlier. Maybe that's our starting point to really dive deeper into the housing market now. What does it look like? What's the delinquency rate? What's the mortgage default rate right now? How are we looking? How close do you think we are to that breaking point that we've seen in 2008, 2009, where it's like, okay, we're done?
Brother, there's already people that are done. That's what I'm trying to tell you. Now, let me explain the delinquency stuff. So here's the problem with the delinquency stuff.
Can I jump in real quick? Sorry. It's like just for reference sake, so people can understand. Because when we watched the movie The Big Short, of course, people drove to Florida to see, okay, what was going on in the housing market, right? People were done at that point also, because it was empty. People had to sell. There was only one guy in that one neighborhood, and he was putting out the for sale sign because he was done, right? So my point is, like, trying to reference here just to people have a bit of an understanding and can frame it. Are we at that stage where it's like, okay, this is a bubble, we got to get out? Is this where we're at?
Brother, we've been in a bubble. We're in a double bubble right now. I mean, and I say bubble when we look at price to earnings. So how much money do we make compared to what are the prices of houses right now? We're at 7.38 PE ratio for homes right now. I have the chart up here, but it's never been that high. Even during the global financial crisis, the bubble was smaller than the bubble is right now. The difference between the global financial crisis and right now, a couple things. One, you could say inventory is lower to start out with, but the biggest difference is the Federal Reserve. So the inflation is out of control, and now we have a renegade Federal Reserve that will bail out the banks at a drop of a hat. And that's the biggest differences. So the bubble's already here. America's been waiting for relief for the housing market, prices and affordability to come back. But I will also say this, it's barely even started. I mean, it's barely even started. And because anytime something happens in the financial market, and you can go back to 2023, they bail out the banks. And you can see that when you look at home price decline at the second half of 2022 into 2023, those home price declines shifted the second that Jerome Powell came out. I think it was on a Saturday over the weekend, and said, we're not bailing out the banks, but we're going to create this bank term funding program over here, and we're going to help them. Dude, and so they treat us like morons, man. And it really frustrates me that it works on people, and people, it goes in one ear and out the other, and like, oh, okay, cool, I don't have to worry about that. They keep their heads in the sand and they continue to doom spend and live a lifestyle that they have been sold. They don't, half the people living in credit card debt, I'm telling you, brother, they're not happy. They're not happy. I know that because I lost everything and I was one of those people. And I spent more money back in 2009, right before I lost everything, than I did my entire life. So I spent more money than I ever have spent when I had the least amount to spend. And I lost everything. And it sucks.
I believe that. I believe that. Coming back to The Big Short real quick, interesting questions. Did the rating agencies learn anything from that debacle? Have they caught up? Have they sharpened their pencils and figured stuff out and how to rate this properly? Is that so? So what's the credit risk right now? I don't want to get too complicated here, but I think it's something people could follow and try to understand a little bit.
Right. Well, they did learn that they could get away with bullshit, excuse my language, and that they could create a system that's so confusing it creates apathy where people cannot mathematically look under the hood. So they've learned to manipulate the market is all they did. These rating agencies are, I got to be careful what I say here. These rating agencies continue the fraud. That fraud circle, the fraud bubble, the debt bubble, because here's the thing. These rating agencies aren't taking two really, really important things into consideration. Number one, real median household income. And number two, the out of control deficit and government debt right now. They don't take those things into consideration. The rating companies are ridiculous and designed to continue to get us to spend our money. They are reactive. They will only change their rating when it's too late. They are complete waste of time and part of the fat and greed in the middle that needs to be removed.
I fully agree, because especially you can pay for your rating. You can just pay for it. Doesn't matter.
That's not a real rating. It's
no, absolutely not. But people gobble it up and love it.
They love it, man.
How's the housing market doing in general? I know you brought some stats. I'm curious, like, what are we looking at? How dire is it out there? Melody Wright says, like, we're in crash territory, housing market crash, but we haven't really seen prices come down. So I'm curious, frame that housing market in general for us. We talked mostly about the consumer. The consumer, obviously, mom and pop are struggling badly. How's the housing market looking in general? We're being told there's an undersupply, everything's fine, and so on. You get the narrative. How's it looking, Travis?
It's bifurcated. I mean, it's very, very hard to understand what's going on. But again, you have kind of two pieces of the market. You have existing homes and you have new homes, completely different. And then from there, you also have two different types of buyers, which is the pre-quantitative tightening and post-quantitative tightening. And then from those, you also have, for example, New York versus Texas. And so I live in Texas. And so, you know, I can, do you want me to show you some stats real quick?
Yeah, please. Absolutely.
All right. I'm gonna take you through this really, really quickly because it's just gonna be easier for me to just kind of go through it. Let's start with inventory. What you're looking at here, and stop me whenever you want, okay? Because I'm just gonna speed through this. What you're looking at here is active units for existing homes. Okay, so existing homes right now. This is updated for March 2025, and this is not pending. This is only existing active. It's sitting at 892,000. Now, I want to point out that is still under where we were at pre-pandemic. But if we look at February of 2020, right before the lockdowns, we were sitting at 928,000, which means we're roughly 40,000 off from pre-pandemic. Granted, the bare minimum pre-pandemic, we're only 40,000 off. But here's the interesting thing. When we add this right here, which is the monthly supply of new homes, we have way more new home inventory than we did pre-pandemic. So when we combine these two units, we have more inventory than we have right now. Than pre-pandemic. So we have more inventory right now compared to pre-pandemic. Okay, you see that right here. Look at this. We have 8.9 months of new homes right now. These new home builders are screwed, man. Now let's keep going. Let me show you the bifurcation. I'm going to show you the top 4 housing markets in the United States, starting with Florida. This is active. Look at the inventory in Florida. This is freaking crazy. It's off the chart, brother. It's off the. They need another chart next month. Look at this. It's off the chart. It is way more. Inventory in Florida is way higher now than it was pre-pandemic. Look at this, okay? This is Texas. Same thing with Texas. Texas is almost off the charts as well, but way higher than pre-pandemic. Now it gets bifurcated after that. Look at the other top housing market, California. So California is sitting at roughly 57,759 right before lockdowns. Look at this. February 2020, we're at 51,000. So California has more inventory, barely. It's barely more, but they have more inventory than pre-pandemic. But look at this. This is going to shock you. New York is screwed. New York is going to go through an unaffordability crisis, but New York is way under pre-pandemic. Do you see that? So they only have 29,600. Meanwhile, pre-pandemic, they had 49,000. So that's how bifurcated it is.
You asked me to stop you. It's like, why is New York so different? California, I can sort of get, but why is New York so in demand? Like, have a lot of headquarters moved there? I'm really trying to understand what's going on.
I think people are locked in their houses from selling, but I think probably the primary reason is new home construction. Texas and Florida lead with new home construction, and new home construction eventually eases into existing home stats. And so being that Texas and Florida have the highest concentration and clusters of new homes, I think that's why you see them skyrocketing. Whereas New York, they don't have a lot of new construction because they got skyscrapers everywhere. There's literally almost no room to build there.
And can I ask, New York City or New York State?
This is New York State.
Okay, but mostly like mass populace obviously is in the New York City area, I'm assuming.
Yeah.
So that's why those numbers are so tight.
Yeah. So
okay,
that's New. No, you're good. Now let me show you something else here. Okay. This is Redfin's data, and I hate using methodology. I would prefer the raw data. That's why I love MLS analysis, because it's raw data and it's not tainted. This is tainted. This is methodology. But if we look at the 4 weeks ending April 6, 2025, this is the 4-week rolling median average. Okay, it's just another way for them to bullshit people. Now on this column right here, you're going to see there are metro areas that are now outside of Texas, outside of Florida, that are declining. A total amount of the 50 top metros, 8 of them have year-over-year decline. And actually, this is very interesting. Indianapolis, and I'm not 100% sure why. I have to do some more research. But Indianapolis is leading the way. What? At negative 4.4% year-over-year, followed by, obviously, Jacksonville. Montgomery County is 1.6. Dallas, 1.3. And Tampa. Now, there's also others. There's 8 others. But also, out of respect for the bifurcation, look at the other side here. So then you have other metro areas like Cleveland, Ohio, that's up 12%. Milwaukee up 10.7%. They always hassle me because I never pronounce this correctly. Newark. I didn't do it right. They're gonna roast me, man. 8.8 up. Nashua County 8.8. New Brunswick 6.9%. And so that's why I keep telling people, take my free courses, learn the math, so you don't have to look at this nonsense, because there are places in Indianapolis that are still going up, and there are places in Cleveland that are going down. In order to determine that, you have to use raw data. But when we go on, okay, and this is what I was referring to earlier, one of the problems with the housing market is people don't want to buy because they can't afford it. The housing market is so emotional that a lot of people, if they could qualify, would buy a house even though it's very unaffordable, because it's an emotional thing. But look at the gap. Home buyers need to earn $50,000 more than renters. When back in 2020, it was very close, right? It was what, a difference of about $7,000, $5,000 to $7,000. That's got to $50,000. And on top of that, here's the gap I was showing you earlier. So to own a home, they're saying the spread. So the spread right now from renting to owning is $824 a month. And that's low because that's not taking into consideration like homeowners association, repairs, and things of that nature. And when we keep going, the other issue here with the housing market is the overwhelming unaffordability. And I'll show you AirDNA, and it's going to blow your mind. But look at the change in property taxes. Here's the 5-year change in blue. The 1-year change is in gray. So property insurance went up in 5 years, 61%. So even if you had an interest rate of 3% and purchased in 2020, guess what? You got bamboozled because you didn't realize your homeowner's insurance was going to go up 61%, and property taxes up 22%. Interest up 21%. Total PITI up 24%. But these are the two adjustable costs right here: your property insurance and your property taxes. And so that bamboozles people, especially because of this chart I showed you already. People aren't making more money. People are making less money. And you see the bubble here. This is the home price to median household income ratio. We're at 7.36 right now. This is historically high. We've never had prices when compared to median household income this high. That's why I'm saying, people, we're actually in a double bubble right now. Here's the global financial crisis, the last bubble we were in. That was at 6.78. So 6.78 years to pay off your house. Again, right now we're in the 7s. And a lot of people like to compare what happened in the 70s and 80s, because the inflation to right now. But what I try to explain, so they're like, hey, house prices aren't going to go down because they didn't go down in the 70s and 80s when we were battling inflation. I'm like, yeah, they are. 1, because of wages, but 2, but look at the PE ratio in the 70s. It was 3.92. So you can't compare it without looking at median household income and the actual prices. It's very, very low. And when we keep going, the other issue here is these massive natural disasters. Now, I went to Western North Carolina and Tennessee for 36 days for Hurricane Helene. And it changed my soul, man. I don't even think I'm recovered from that. I mean, it was actually soul wrenching. But here's what I wanted to show you. I also went out to the California wildfires. Okay, so in the Palisades wildfire, okay, the change in mortgage delinquencies and people that are starting to become late on their mortgage is 28%. In Eaton, it's 21%. If you look at Asheville, if you look at the hurricanes, you're going to find similar trends. So the natural disasters are increasing foreclosures like crazy. However, just like the global financial crisis, people like the global financial crisis was because of subprime. I say prices went down more so because of speculation and investors. I was a residential loan officer during that time, so I think I have a right to say that. And I want to bring your attention here. This is AirDNA. They're saying right now, and I showed you there's about 900,000 active listings, right? I showed you that. AirDNA is saying that they have 651,000 Airbnb homes or short-term rental homes for sale. 651,000. Oh my God. So it's possible that Airbnb and short-term rental leads the housing market crash. But here's the thing. I barely even talked about new homes. Look at this. This is Lennar. This is in my own backyard here in Houston. People are like, as soon as rates go down, remember all the realtors, as soon as rates go down, oh my God, there's going to be a rush. There's going to be this rush, this skyrocketing rush of buying demand. And I'm like, no, they're not, because the price is more important. Hello, right? You got to look at the price, you guys. Look at what they've been doing in my market. The new home builders here in Houston, and they cannot sustain the houses. The house prices are still dropping. They've been giving people rates in the 3 and 2%. Right now, they're offering a 3.75 right now, and the prices are still going down. And here's another thing. If you want to know where the new home data is, you got to go to New Home Source, and this is underreported. I know that because Melody Wright and I have been going across the nation, and we've been counting the amount of inventory and cross-referencing that with this software and the Census Bureau, because a lot of people use the Census Bureau, a survey, right? And only 74% of people even fill that out to tell us what's really going on with new homes. And we're like, no, you guys, they're lying. What's really going on? You got to go boots on the ground. But look at this. In Houston, there are, and this is underreported, I'm saying there's double to triple this amount of homes. But they're saying right now there's 12,598 new homes for sale in Houston. That's absolutely nutso. And again, if I were going to continue, I can actually show you what you see here. This is where you get raw data. This is called the MLS, okay? And what I like to do, especially if there's any realtors watching, I like to supersede all of this emotional nonsense. Like, what's the size of the house? How many bedrooms? How many bathrooms?
Oh, I want to turn my 3 into a 4-bedroom because I'll get more money. I watch way too much HGTV, so.
I know, right? Right. Okay, so this is countering HGTV. This is the counter to that. This is using math. And what I've done is I add a separate field. It's a data filter field of price per square foot. So I supersede all that. I put a price per square foot here, and I take 30,000 listings and I turn them to 2,200 listings. And now when I look at listings, all of the noise is blinded out, and I can now identify listings that should be under market value. So all of these listings you see here should have wedge. Okay, you don't see any right there, actually. So I guess there's none right there. Okay, so let me show you this now. So for example, here's a listing that's under market value. I want to show you the tax fraud. Give me a minute. I'm going to tell you this. Okay, so this home is for sale for $407,000. There is a $60,000. This is an active listing, by the way. There's a $60,000 price cut. This has been on the market for 122 days, but a total of over a year. That's a CDOM right there, which is combined days on market. Okay, so 407. These guys can't sell this house for 407. It's being sold for $100. Brother, this house is being sold for $104 a square foot. Okay, but here's
beautiful
the issue.
Home.
It's a nice house, man. That's what I'm saying. But the problem is also the payment because property taxes. So again, they can't sell it for 407. Let's see what the county has assessed it for. Is it 407? Is it higher? Is it lower? So instead of assessing it, okay, actually, let me go back. This is the wrong one. That's okay. I apologize. I have to go back to the map. Okay, so let's go back here. Let's go to this one, 337. Let me go back. I apologize.
No worries. It's
Okay.
interesting.
So the same thing here, 307 price cut, 50 days on the market, 117 a square foot. This is for sale for 337. Let me go to taxes. Okay, let me go down here again. So instead of so here's a good example of one here. So again, the house can't sell for 337, right? But the county is taxing the house based on 383,000. It's overassessed $50,000-$60,000, and the total taxes on this house per year, brother, $9,000 a year.
Insane.
That's what I was trying to say. So the fraud, this is the fraud. What they're doing here is they're taking all of the bond debt that is fraud from the schools, and I want to help our children. I believe in helping our teachers, but they're rolling it into the software that is designed to value our houses, and the fraud is so bad that the value of our houses is just so ridiculous now. I mean, we're filing criminal complaints. We're filing criminal complaints right now because they are robbing us of our future equity in the form of property taxes and overvaluation.
Maybe the wrong question to ask, because I know you're quite emotionally involved, and I hope it doesn't set you off. Is it fraud, or is it just bad software and a slow adaptation to changing market? You know, like you probably heard that argument before, so I'm curious.
It's 100% fraud.
Yeah.
And I'll tell you why. Because they're supposed to, the central appraisal districts, first of all, are owned by the schools. How does that work? Anyways, the largest taxing entity owns the central appraisal districts. So they're required by law. Well, first of all, it's unconstitutional to tax us on this. So we won't go into the tax. We won't go into that. But the software is supposed to use something called USPAP. It stands for the Uniform Standards of Professional Appraisal Practices. Okay. USPAP. That's how an appraisal is done. You use comparable data, you create a value for the characteristics, and you compare an apple to apple, and you make adjustments appropriately. There's mathematical formulas. Plus, they're supposed to use formulas like standard deviation, which is something designed to protect us as taxpayers from fraud and corruption and inflation and things like that. And so they're not using USPAP anymore. They're not using standard deviation. These counties are purchasing software from private companies that are acting like they're using USPAP, but they're not using USPAP. They allow the operator of the software to go in to manipulate the numbers. So you can actually put a budget in some of this value software. You can put the school's budget in the value software. A budget should have nothing to do with value. And so it is 100% fraud. It's fraud to begin with, because you're not, the Constitution of the United States, you're not allowed to tax us on our property. On our income, yes, but not on our property. And we haven't made any income on our property, the ad valorem. So you can't do that. So it's 100% fraud, but it's also the software is doing what it's supposed to do, stripping mom and pop of their equity.
No, really interesting discussion there, Charles. We could go on forever, obviously, but we do have to put a bow around it. Maybe some last minute advice here, or last minute, because it's the last minute of our conversation here. But for any potential home buyers this year, like in 2025, what should they be looking out for?
Well, I mean, I think most people have to redefine what a home is, and a home is where your heart is. A home is where your relationships are. And the best investment most people could do right now is investing in themselves. If you invest in yourselves, what I'm meaning is learning the process. One of the best advice I can give you is go to my Real Estate Mindset Empowerment Center, take my free courses. All of it is free, and all of it is going to teach you the under the hood math on how this works. But really, if you're on the sideline and you're forced on the sideline, right? So you're not making a decision, you're forced on the sideline because of unaffordability. There's 3 things that you need to be working on right now to put yourself in a position to where you can win in the future. And that is your credit, your income, and your assets. Those are the 3 main factors that you need to work on to get a mortgage. And credit, generally, it needs to be 740. If your credit's low because you have credit cards maxed out, understand that something called utilization ratio is one of the quickest ways to get good credit. And utilization ratio only applies to credit cards. And that means having your credit line 30% under, having your balance 30% under your credit line. So make sure if you have credit cards that those balance, well, you shouldn't have credit cards to begin with. But if you do, make sure the utilization ratio is low. So credit, you want a 740. Income, understand that as far as income qualifications, FHA allows your back end ratio to be 56.99. Here's what I want to say about income. If make as much money as possible. Get a second job, become self-employed, but understand for qualifying for a mortgage, you need a 2-year history of self-employment or a second job a bonus, overtime, or commission. You should be doing that, but beware that it may not be able to be used for qualifying. Now, the third thing is assets. Most people, if they're going to buy a house, have 6 months to a year of money saved after you move in. A huge problem that a lot of people are doing is they're going broke purchasing a house, meaning they're spending all of their money to move in. You do not want to do that. So you got to work on saving your money. Some of the best ways to work on saving your money is learning how you spend it by going into your bank statements, seeing how you're budgeting. Biggest areas of improvement most people can make is going out to eat. Stop. If you want to buy a house in the future, you want a great deal, stop going out to eat right now. We're on the front end and probably already in a recession. And subscriptions, cancel your subscriptions, be patient, learn to do something called subdivision analysis in your local real estate market. I have a free course on that as well.
Fantastic. Travis, wonderful insights, really, really smart ideas, and really, really good input in general. I hope people take your advice. Really appreciate you coming on. It was really insightful. Thank you for sharing, your insights into the real estate market. It was really helpful. I learned a lot again. Like I'm by no means a real estate expert, but I love browsing through listings of they're beautiful homes. The one for $404,000. There was 3,700 square feet. Holy moly, that was a phenomenal property. You don't get anything. You can't get a garage here in Frankfurt for that money.
Right. I know it's crazy.
I'm exaggerating a little bit, but you're not far off. So from a garage here. So fantastic stuff. Thank you so much, Travis. We'll obviously link to your YouTube channel and everything down below, of course, as well. So thank you so much for your time for coming on, and everybody else, thank you so much for tuning in. Tremendously appreciate you watching. Hope this was educational for you. It was tremendously for me. If you did enjoy the conversation, leave a comment, leave a like down below, and if you haven't done so, hit that subscribe button. It's a free way to support our channel, and we tremendously appreciate it. Thank you so much for tuning in. We'll be back with lots more. Take care.